welcome to this next episode on financial planning. It's been a while since I put out a video. I was sidelined by some other marketing efforts, but I'm back. I just want to complete this series on the taxation part. So today I'm going to talk about taxation on equity funds, the long-term effect, that is if they've held for more than a year. It's quite useful to investors, quite attractive. Of course, we have to time ourselves when we exit, but if timed rightly, the taxation here can be quite a powerful benefit, right? So let's get on with it then. As most of us have fixed deposits, let's quickly look at the taxation on fixed deposits and then use it to compare the taxation on equity mutual funds. So as we know, the tax on fixed deposits is charged as per the income slab that we are at. So interest is added back to the income and then taxed as per that slab. Let's look at this with an example. If our annual income is 10 lakhs and if we earn 1 lakh from interest on fixed deposits, our annual income is considered as 11 lakhs. And so we are taxed at that bracket. Is there a TDS component in fixed deposits? Yes, there is. TDS is nothing but the tax deducted at source. Now, in a fixed deposit, deduction is made every year when the interest is earned. For example, if an FD is booked for 4 years and fetches an interest of rupees 45,000 per annum, so instead of giving the principal plus interest minus TDS at the end of 4 years when you redeem the FD, instead of that, every year the 4,000 rupees, that is 10% of TDS, will be deducted for 4 years. So irrespective of whether you use the money or not, your tax is going to be deducted. Let's look at the taxation on equity mutual funds for the long term. So when you redeem your mutual funds after holding it for a period of 12 months, that is 1 year, then the gains that you make are classified as long-term capital gains, right? Capital gain is defined as a profit one gets while selling an asset or an investment. So when you sell your mutual funds, whatever gains you make, if you've held it for a year and then you're selling it, that is termed as long-term capital gains. The taxation on that is 10% without any indexation benefit. How is this applied? So it is calculated separately, like whether you have an income or not, or that is not taken into consideration. The tax is calculated on whatever gain you made, and then whatever your other tax liability is, that is whatever taxation you have to pay, this amount of tax is also added to it. Is there any TDS? There is no TDS again here for resident Indians. You will get the full amount credited. That is, suppose you bought for 1 lakh, you sold for 2 lakhs, you will get the entire 2 lakhs credited into your account. When you're filing your returns, you have to provide a capital gain statement and do the calculation as per that. Let's see how this compares with fixed deposits. So let's assume that somebody invested 5 lakhs in the year 2015-16 financial year, and then the return rate they were expecting is 7%. So that means when in 2021 financial year, after 5 years when they redeemed it, they got 7.01 lakhs. So the amount to be taxed here, the gain that they got in fixed deposits, the interest gain, is 2.01 lakhs. What happens to this gain? Suppose the person is at the highest bracket of taxation, that is 30% tax, then on this 2.01 lakhs also he'll have to pay 30%, and so it will be 60,300 rupees will be the taxation. Now, so your returns after tax is reduced to 1.4 lakhs rounded off. Now, what if the person was investing the same amount in equity funds? Then he or she would have got, let's assume 7% rate of return, although we know that equity funds are not as defined, or it doesn't happen every year, but just for the sake of comparison. So let's assume that they got 7% year on year. The amount to be redeemed remains the same. The amount to be taxed remains the same here. So the gain is 2 lakhs, 2.01 lakhs, but the taxation differs. As I said, it's a flat 10% taxation. So now you can see the tax is reduced here. It's only 20,000 rupees, almost by 1/3 in this example. And therefore the returns after tax goes up significantly. It becomes 1.80 lakhs. What if a person is at the lower bracket that is 10%, then the taxation reduces, the tax amount becomes 20,100, returns after tax becomes 1.8 lakhs, which is similar in this example to the equity fund taxation, right? But there's one more point that we have to consider here, that is the long-term capital gains on equity shares or equity oriented units of the mutual fund are not taxable up to the limit of 1 lakh. What does this mean? It means that if you're holding a mutual fund that predominantly invests in equity, that is in shares, then the first 1 lakh of gain is not taxable. Let's see how this applies in real life. So now what we were thinking is that the amount to be taxed was 2.01 lakhs. But if you take away that first 1 lakh, which doesn't need to be taxed, then your amount to be taxed itself comes down. It comes down to 1.01 lakhs. Your tax is charged at the return of 10% on this gain. So it becomes 10,000 rupees and your returns after tax go up to 1.90 lakhs. Almost a 50,000 rupees difference in this example, right? Even after, even if you're at the lower tax bracket, like I said, it doesn't matter which tax bracket you're at, but in a comparison state also, you're taxed only 10,100 here vis-a-vis 20,100 in the fixed deposit example, and therefore your returns after tax goes up again. One more point that we have to remember is that equity funds, the 7% rate which I've taken after a 5 years is quite possible, but there's always volatility. It might be lesser also, it might be more also. Ideally, an equity fund investor should have a margin set in mind and should try and exit at that time. After they achieve that goal, then they should try and exit, not before that. So typically if you set a 10-12%, then your amount to be taxed also goes up because you're earning more, right? So that also goes up. So these are some things which make the equity fund powerful. So I hope I was able to clarify how long-term capital gains is taxed in equity mutual funds. The idea here is not to say that don't invest in fixed deposits, they're not good, right? Each equity funds has a purpose and fixed deposits has a purpose. Invest in it for its own sake. Don't invest more than what you feel is comfortable or what suits your risk appetite. But it's important to understand the taxation effect as well so that we can use it to our advantage. If you have any queries, please leave a comment or reach out to me on my contact points. Stay subscribed to watch more such videos. Thanks.